Hello, everyone. Well, there's in the earlier explanation, there was examples of how to set up T accounts, examples of journal entries. I don't think we can ever get too much practice in writing journal entries and to T accounts and then to financial statements. So this is another uh, additional example. You can follow along, see how we might go about working through a problem through the entire accounting cycle, which means starting with the last year's amounts. Here's at the end of 2025, assets, cash, accounts receivable, inventory, prepaid, supplies, property, plant and equipment, land, accounts payable, under liabilities, under revenue, interest payable, salaries payable, long-term debt, some totals, and capital stock and retained earnings. Just like we've learned the format. So those are going to be our starting point for 2026. So those become our beginning balance, as we'll see in a minute, to our T accounts as we start the 2026. So what we want to do is make these transactions as journal entries, and then we're going to put them into the T accounts, post them, if you will, and then create a trial balance, and from that trial balance create financial statements. So skipping to the next step, I have a separate tab, and you don't have to do journal entries in this green format, but it kind of makes it a little easier to read. And we're going to do this transaction. So I've copied what was over here to be right here, so we don't have to flip back and forth. So we're going to go in here and we're going to put the date. And the dates are important only to the point of getting it in the right accounting period, whether it's the third or the fourth or fifth. As long as it's all in the accounting period is a month, then as long as it's in January, it's all going to look the same on the financial statements. So the first one here is we're going to pay interest payable, all right, plus $2,000 towards long-term debt. So we're going to pay, that means cash. That's we're looking at which accounts are affected and by how much. Well, we're going to affect interest payable, so we have to go back to our beginning and see what our interest payable was. It was $2,100. So we're going to make that go down. We're going to pay it. So interest payable is going to be is a liability, so that goes down with a debit. And then we're also going to pay long-term debt, also a liability, and therefore we reduce it with a debit, 2,000. So together, the cash amount that we paid, if we paid those, is 4,100. Okay, so there's your journal entry. Balances, debits equal credits. We can even keep a total down at the bottom if you want to make sure that you don't get that off, but we can pretty easily see that that is in balance. Okay. Put the date again. Okay, we're paying the salaries payable. So salaries payable is $2,350. So we're going to debit that because we're going to make it go down. Whoops, salaries payable. And we're going to credit cash because that's going to go down because we're going to pay the cash. All right, we're off and rolling. Okay, purchase inventory of $6,100 on credit. Inventory is one of the accounts we can use. 6,100 on credit means we're not going to pay for it now. We're going to pay for it later. So that's accounts payable. That's where the term on account means, or on credit. All right. Purchase supplies on credit for $850. So separate account for supplies on our balance sheet. And again, we use accounts payable. And we received $2,500 for customers for the products to deliver in March. Okay, so we're in January. We're receiving money for things we're going to give them in March. Whoops. So that must be, we haven't done anything for that money. So that is going to be debit cash. We're going to receive the cash, 2,500, and that must be unearned revenue, a liability, because we owe them those products. Okay, on the 10th, we're going to sell 300 units on credit with a sales price of $90. So 300 times 90 is going to be a debit to accounts receivable. Okay, because we're going to receive it later. Okay, on credit means they're going to pay us later now. And we can even use Excel to do the math for us. 300 times 90. And then that is also because we will have provided the product or the units. That's revenue. Same amount. And then, but they cost us $50. So there's always two when we sell product. Okay. Cost of goods sold, or COGS. Okay. 300 times 50, right? Record the cost of that. And that is a reduction into our inventory. All right. We're going to, on the 20th, we're going to pay on accounts payable. So accounts payable is going to be a debit. And we're going to use cash, of course. All right. We collected from customers some of the accounts receivable. So our cash is going to go up. And accounts receivable is going to go down with a credit, right? Because it's an asset. So we make it go down with a credit. We're going to pay some wages. And it looks like they're wages that were for work they did during this month. Okay. Wages expense, 11,000. So we pay it in the same month as it was earned or used. Record an expense and cash. It's not going to be paid later. That would be a payable. It's paid right away. Okay. Received a utility bill that will be paid later. This is that kind of a scenario. All right, so we have utilities. We've used the utilities, so we need to record the expense. But we're not going to pay for it until next month. So, two choices. We could put in accounts payable if we wanted to, or utilities payable if we wanted to separate that one from all of our other amounts we owed. Okay, either one is fine. Okay, provide customers with services they paid for $2,300 in 2025. So some of the unearned revenue that we had received earlier in 2025, see there was unearned revenue on the balance sheet when we started, has been earned. We provide them services. That's what that says. So we, at the end of the month, we figured that out. So we're going to debit unearned. This is a adjusting entry now. All right. Now that becomes revenue because we have actually done that. So that's something we could look at the end of the month. Look at the contracts we sign with these customers and see if we've done the work necessary to record revenue. All right, probably don't do it every single day, probably at the end of the month, okay? Supplies, we counted the supplies and found 940 remaining. Now, here's where we have to get, we bought some supplies, all right, of 850. We had supplies of 1920. So that's 2770. And we have 940 left. So 2740 is how much we have recorded. And then we still have 940, so the rest must have been used. 1800. Wait a minute, let's check our math on that. Let's make sure I picked up the right numbers. 850 plus 1920. Yep, 2770 is how much we had, and we have left over 940. That means we used, and used up asset becomes an expense. So used supplies become supplies expensed. So supplies is an asset until it gets used, and it becomes the supplies expense. All right. Employees worked and earned $1,700 in January that will not be paid till February. So this is employees that have worked. We count up their hours they've worked since last time we paid them. And noting that we're going to pay them again in February. That's a payable. So we got our wages expense. Since we're using that instead of salaries, we could use salaries. It wouldn't make that much difference. And let's call it wages payable. I tend to like to use that and keep it separate from accounts payable, but technically you can put it in accounts payable just like our choice earlier with the utilities. All right, got a couple more. Interest on long-term debt for 12%. We just need interest for 1 month. It's 12% for a year, so that means 1% per month. So we owe 1% of interest on the long-term debt. So we go back here, we see our long-term debt 62.2. And so if we do the math, 62,200 times 0.01, that's 1%, 622. All right. So whenever you're dealing with interest, you need to make sure that you know the time period that you're recording for and adjust accordingly, because interest is almost always stated on an annual basis. How much is charged per year, but a lot of times we're not going to record it just once a year. We're going to record it more often. That would be interest payable. Again, I usually separate that, but if it went in accounts payable, it would still look very much the same on the balance sheet, still be a current liability, and therefore wouldn't make things too different in terms of the story. But you may want to know separately what you owe for interest versus what you owe for other bills. All right, and the last one, the prepaid insurance will last 4 months into 2026 before a new policy will be required. Okay, so what that says is this prepaid insurance, 1,600 in the beginning, okay, is going to last 4 months. 1,600 divided by 4 is 400. 1 month has gone by. It's January, so we've used another month of insurance. So we need to make an adjusting entry for 1 month of insurance. So that insurance, prepaid insurance becomes been used up. A used up asset becomes an expense, becomes insurance expense, 400. Okay, and then we're going to credit to make prepaid insurance. We're going to credit that and make it go down. So we've made the prepaid insurance go down by 1 month or $400, and the insurance expense makes our equity go down, even though we talk about it as expense going up. So in every case, our journal entry, we have a debit and a credit. We have the amount of debits equals the amount of credits. That's the key thing. Now, time to post those in the T accounts. Now, I have already put them in, okay? So let's quickly look at how we would have done this. Notice that in the beginning balance, we take the cash from 2025 and we put it as a debit because it's an asset, and the normal balance for an asset account is a debit. And the same thing with accounts receivable. See, now it makes it pretty easy if we keep them all kind of together, right? So the next asset is inventory, and we keep the inventory here with assets, and there's the 18,420, 1920 for supplies, and the 1,600 for prepaid insurance. Then the long-term assets, if we keep that separate, 62,300. Whoa, we better do that. You can see we made a mistake there. 62.2 and 62.3. That's a kind of error that's easy to make. Why we do this in the computer, computerized accounting software, where that mistake couldn't be made, because that would throw us off. Okay. Going all through the liabilities. Their credits. Oh, wait a minute. I was right. Property plant, it was 62,300 was the property plant equipment. 62.2 was the long-term debt. So there we illustrated another possible mistake, is you get numbers that look the same but go in different places. Interest payable, okay, unearned revenue, salaries payable, those are all credits to start. I put them all here in liabilities, long-term, capital stock, and retained earnings. All of those numbers started from our beginning balances. Now, from our journal entries, and we'll see just a couple of those, okay, we have our first journal entry is a credit to cash. And how you put these in the T accounts, what order you do is up to you. Cash. And what I would do if I were doing this is I would check them off somehow, or make a little note that you have put them in the T accounts. So here's the cash credit, 4,100. All right, and we're paying interest payable. So there's the debit. All right, and then long-term debt, 2,000. So the journal entry describes what to do in the T accounts. Salaries payable, next one. Debit, okay. Now, there we go. We made another mistake. This was 23. And we noticed something also over here. We have call it salaries payable, or on the journal entry, salaries payable, and here it is, wages payable. We can use those interchangeably. We're not going to let that throw us off, but we are going to go ahead and keep it the way it is with salaries payable here, and then down here when we use wages payables, we're going to make our note that that's really salaries payable. Okay. Others that you might want to check and make sure that you do this sale, accounts receivable, the one that had the most complicated one. Okay. Accounts receivable, debit, 27,000. Sales, credit, 27,000. Cost of goods sold, here under expenses, 15,000. Debit, credit, inventory, 15,000. So nothing has more than 3 or 4 entries in the T accounts, at least at this level. Obviously, in a real business, you'd have dozens, and these could have hundreds of literal journal entries going in there, which again is why we use accounting software instead of even something like Excel, as much helpful as it is. Now, when I set this up, and it's described in the other how to do that, you can just use borders, but you're going to have to total each account. Each account needs one balance. So cash is the easiest one. It usually has the most things happening. Okay? Because it's an asset, we add up the debits and subtract the credits, and that gives us 1440. That comes over and goes on our trial balance as 1440. Accounts receivable, add up the debits, subtract the credits, goes over here. Same with supplies, which we expected to be 940 because that's what we said in the thing. Inventory, prepaid, all of the assets work the same way. Now, accounts payable, we add up the credits because the normal balance of a liability is a credit. So we add up the credits and subtract the debits. So, including the beginning balance, add them up, subtract what we paid, and that 29,692 goes to trial balance. So each of those numbers comes over. I actually have a formula in each one that refers to the cell. You don't need that. You can just type it in. But this makes a lot fewer mistakes if you have a formula referring to that. My total is down here, 186,806 for both the debits and credits. So my trial balance equals, notice, one amount for each account. Now from there we can make financial statements. Okay? So we always make financial statements in the order income statement, statement of equity, balance sheet. All right? We can do this as make our life a little easier. We're going to copy that didn't seem to work. Now, there we go. I'm going to paste the values because the formulas aren't going to work over here. Okay? So income statements. What goes on our income statement? Right from the trial balance. We got all the numbers we need. Sales. Okay? Last cost of goods sold. Equals our gross profit. Okay. And then we can subtract our other expenses, utilities, insurance, wages, interest. Now we have found the thing that mentioned that the new balance was how much we calculated the interest on. Forgot to record think about how much was paid on the loan before we calculated the interest. And so it would only, they paid $2,000, so we save $20 on interest. All right. All right, and then let's see. We're missing supplies. See again on if it's on the balance sheet on the. All right. Okay. Supplies, expense. Remember that's what we used. So we don't have any tax expense in this particular example. Okay, so we'll ignore that. And then we have our net income. You could total your expenses before you calculate net income, or you can just take the gross profit and subtract your expenses. However you want to do that, whichever is easier, makes the most sense for you. And our net income is negative 2432. Okay. All right. We have more expenses than we have revenue. So our statement of equity starts with beginning balance. Because we're doing a statement of equity, not a statement of retained earnings, we're going to do a capital stock column. Okay, and there were no changes to capital stock, so it started the year and ended the year at 30,000. Retained earnings. They started at, because that's what was left from last year, we have our net income when it's negative. Okay, usually refer to it as a loss. We're going to put that as, I'm going to go ahead and put that in as a formula. And then our ending balance is going to be okay, 28,380, and then we can do the balance sheet. Okay. You can see where we're getting the all the numbers. Okay, again, we could use a formula or just type. Okay, formula is going to give us, so if we did a formula, we could just do like this. All right, see how easy that is. I'll use some abbreviations here. Speed things along. Okay. And we're pretty confident that our balance sheet is going to balance because our trial balance balanced, right? Okay. Now, these first 5 are current assets. Okay. So we can go back, once we have this all in balance, we could go back and put a subtotal for the total current assets. But let's just do the total. And then let's go ahead and put in our liabilities. Accounts payable. Unearned. And there's all your liabilities. Let's do a total there. And again, you could put all except long-term debt as current liabilities and do a subtotal, but we're going to skip that step so we can just make sure that we balance. You can feel confident that that is how we can always go back and make things prettier once we have it all working. That's how I like to do it. Okay, now, I just messed up. Okay? My retained earnings should not come from here. That's beginning. I want ending retained earnings, right? Okay? So I'm going to go ahead and put the formula to add those two together, but then I'm going to fix this and refer over here. Otherwise, we will not balance. Okay? So, liabilities and equity should equal our total assets, right? And it does, 155,074, and we're good. So now we could go back, make it prettier, okay? Put dollar signs, whatever we want to do to make it more readable. Those things are less important than getting it to work. We have everything on there, otherwise it wouldn't balance. So we're in good shape. All right. So that is the process. Then this information, this balance sheet here, becomes the starting point for February, right? And we just do the same thing. That's why it's called a cycle. You do the same idea for February 2026. Write the journal entries, have the beginning balances, write the journal entries, put them in the T accounts. Okay? And you can see why we automated this, because in accounting software, most of this is handled automatically, or a lot of it can be programmed to be done. If you program it right, much of this more tedious work can be done by the computer.